So many people have over time tried to find a permanent strategy, and actually one of them is called the permanent portfolio. So the idea there was that in all situations this portfolio should do well, and it was assets were divided into four groups, which is equities, bonds, gold, and cash. And then the theory was that every year you rebalance it. But over time, the investors and maybe the fund manager realized that this was hugely underperforming a normal debt equity portfolio. So I would say a more permanent strategy for at least a large part of the portfolio can be just plain equities. Because equities over time have outperformed fixed income of the same country by about 5 or 6% per annum. And this has been held valid across countries and across years. And there's a book that I read called Triumph of the Optimist. So I would say a diversified equity portfolio or even an index is actually a near permanent strategy, not necessarily for 100% of the portfolio, but for a large part of the portfolio, whatever you're willing to put into this asset class. So, for example, at Helios and before that at Alliance, I have had now more than 25 years of investing in equities, and I realized that a portfolio of 30 to 35 stocks covering various facets of the market from the highest quality to mid-cap stocks ends up being a very, very good long-term strategy, and that can be seen from our results. But more than that, the fact that equities do better than fixed income over long periods is a given. And then what is rest is to find a good equity manager, and we are as good as any. So over the years, we have seen many crises because I've been around for a long time. So I saw the plague that happened in Surat in '94. And then we had the Asian crisis, Russian crisis, global financial crisis, and Kargil war and attack on Indian parliament. But still, COVID was a different experience and a different crisis because it combined a financial crisis with sort of a health crisis where people that we knew and friends that we knew succumbed to it, viewed as a normal, just a financial crisis. In terms of job-wise and fund management-wise, it showed that we can sit at home and manage as well as sitting in office. And actually, because the markets did well and everybody's performance is very good and our fund is up some 85%. But in no way will I say that this was a good experience because we could not travel. I could not meet my mother. I could not meet my family. We could not meet people. And more than that, some people had much more suffering and pain than they should ever have got. So all in all, we are happy that it is getting over, and we don't want, even with an 85% return in this year, anything like this again. So what Indian market lacks at a big picture level, I think, is contrary opinions. We do not encourage people to have negative views on stocks, at least publicly. We don't have financial journalists who do exposes. We don't have, I can't go and criticize a company openly because the company might feel take it seriously or take it personally or whatever, and things like that, which actually limits the efficiency of the market, and in the end ends up hurting more people than it helps, because the disclosure to the normal retail public are all only about positive things, because anybody who has a negative view has to keep it to himself. This, I think, is a very big negative in the Indian market in a big picture sense. We must encourage, I don't know how, because we don't encourage anything, but we must encourage contrary opinions. The positive thing about India has been, and which has helped me enormously, is to basically follow global trends, what is happening in the US, what is happening globally, and more or less just apply it to India. Because when Indian markets sort of reformed and we all joined the industry in the 90s, it was very easy to see what were the global trends and buy those similar companies in India. For example, if cigarette companies started doing badly in the US in 90s because of case lost by Philip Morris and others, it was very clear that the same fund managers will not come to India to then buy cigarette stocks if they have just lost a lot of money in the US. So in general, if there's the food tech company going public there, you better get ready. that the next food tech company in India will have a very hot reception. And this has worked for us in addition to everything else. So I think it is easier to be a fund manager in India because in some sense we are not leading any of these trends and we are following them from a few months to a few years behind. And that helps in transferring that view and knowledge from there to here. So view means that everybody has to analyze these companies even if they don't want to invest in these companies because of the valuations at which they may come or not come while going public. First is that previously when we had new age companies, because in our days even Zee was a new age company because it was competing with Doordarshan, or Bharti was a new age company because it was competing with BSNL. But at that time, these companies used to go public relatively early in their life cycle. Now, because of the intervention or in between coming in of private equity, which then takes away the growth and keeps it as returns for themselves, the private equity fund managers or the funds. By the time these companies go public, the valuations are quite high and they have come to the market quite late in their growth cycle, where many years of growth have happened while they were private. But following these companies is absolutely of paramount importance, not so much whether you want to invest in them or not, because mostly they are challenging some other sector or company in which you may be invested, even if those companies are the new age companies. So when you say what should be the slant towards these companies is, they have to be viewed very seriously just for the sake of managing a portfolio and to see their effect on other companies. And once in a while invest in them because you feel that they still have a lot of room or the valuation is more reasonable. But that is not an automatic that every new age company is a buy just because now they are new companies as far as the stock market is concerned. Actually, I went to Wharton School to study, and after I was studying there, I applied for a number of jobs. I applied for a job at Helios Capital, and I also applied for a job at McKinsey. So if I had got a job as a consultant at that time, maybe I would not have been a fund manager. It is my luck that I ended up being a fund manager and what I enjoy so thoroughly. But you know, life, when it starts, you are broadly there in that sphere. And I could have got a job with Goldman Sachs and maybe I would have been in some investment banking or something. It is very, very difficult to say what alternative would have been there. But if you today say you choose an alternative and you are allowed to choose that alternative, I would want to be a lawyer because I like to argue just like I argue in the equity markets against consensus and against the generally held opinions. I would love to poke holes in the other guy's defense or offense, and therefore I think I would be a good lawyer.